We are going to get started in about 30 seconds. Before we launch in, I wanted to just do a quick sound check. If anyone could please type in the chat box to just let me know that you can hear me. Otherwise, I would hate to speak for the next hour and then find out I was just talking to myself. So if you can find the chat box, please just let me know that you can hear me, and then we're going to get started. Okay, perfect, perfect. Thank you all very much. Loud and clear. Hopefully not too loud. So thank you all for joining. If we haven't met, my name is Terry, one of the founders of Innovative Wealth Building. As you know, we have lots of advisors in different places to help you and your family on your quest to financial freedom and financial security. Today's topic is going to be a fun one. We're going to talk about 2024, the stock market, other important things that happened. And then we're also going to talk about 2025 and some of the strategies and things to just be aware of to make the most of it financially. So that's really where we're going today. As far as our disclaimer, we always want you to know that this is, of course, supposed to be educational information. Please don't take anything that I say as specific recommendations for your situation. If I'm your advisor, maybe you can do that. Otherwise, I would suggest talking to your advisor about your specific situation. So this should just be a launching point for you to maybe take what you hear and think about it, or to have conversations during your next get together with your advisor. So we're licensed across the country, even some places outside of the country, but we do financial planning and investments. If we talk about taxes and legal things, that's educational only. In those situations, again, talk to a qualified accounting or legal professional. So here's our agenda. As I mentioned, we are going to talk about the stock market. We'll talk about interest rates, inflation, the egg shortage that we probably all saw again. We'll talk about cryptocurrency, artificial intelligence. We'll tie a bow on it with key takeaways and then some practical steps to consider as you go through 2025. So let's jump right in. I love audience participation, so feel free to chime in the chat box. Feel free to ask questions. But I'm just curious, how did we feel about 2024 stock market? Was it good? Was it bad? Was it in the middle? I'm just curious how everyone out there is feeling about the stock market. Okay, Bonnie says good. John says good. Okay. Well, I agree. Overall, way good. Overall, it was pretty dang good. Now, in any year, there's times where we go down 5 or 10% and then it bumps back up, or there's things that happen that cause the market to get a little upset. But overall, it was a good year. Well, how good was it? If you look at the general stock market, the positive return for 2024 was about 25%. So when we do financial planning, we think about what's a good long-term growth rate. Depending on your situation, we might say 6, 7, 8%. Last year was a 25% return on average for the stock market, and that's pretty dang good. Looking back 3 years, we're at 13%. At 5 years, we're at 15%. So arguably, if you have a financial plan, your portfolio might be performing even better than what your plan suggested. And that's a good thing. But that's just the US. And that's specifically the US large cap stock market, where there's a lot more to the stock market than just the US large cap stock market. So we're going to look at international for a moment. Once upon a time, international was a great investment to have. The international stock market used to kick the US's butt. That has not happened in a while. So if you look at the international stock market for 2024, the average return that I pulled was about 3%. And that was using a Vanguard index fund called VEA, which is a pretty good approximation for how the international stock market's doing. Looking at the 3 and 5 year time frame, you see once again that the US dominated by a pretty wide margin. So why do I share this with you? Sometimes portfolios, investment portfolios, are heavily weighted towards international. Let's just talk about federal employees. If you're a young federal employee and you're in the life cycle fund, the L2060, if you take a look at it, you'll see it's very heavily weighted towards international and less towards US. So if 40% of your portfolio only earned 3% last year, you're maybe not so happy. So if you don't know how your portfolio is allocated, maybe take a look. You maybe want to not have too much international because US has been doing a lot better than international for years now. At some point, maybe that will change, but for now, the money is in the US. So I would stick with a good thing that's working well and keep an eye on the international to see when we should maybe put more emphasis on it. Yes, that was a real dollar made out of wood. One of my uncles, he's a master woodsman and or I don't even know if that's a real word, woodcrafter. And he took like 5 minutes and made this in his garage. So it's just been sitting around on my desk. So I thought I'd use it today. So again, the US versus international, the US has been great compared to international in 2024. Let's talk a little bit more about the US because there are lots of ways to slice the US stock market. Now, the general US stock market is based off of the S&P 500. Basically, the S&P 500 is like a basket full of companies, 500 companies actually, that represent the US stock market in general. So the S&P 500 is just a big old basket that has Apple, Amazon, Costco, maybe ExxonMobil. It has all these different companies in one place. And that's the type of investment that I'm saying earned a 25% return in 2024. If we unpack that just a little bit more, you can think about stocks by something called capitalization. That's basically how big a company is. If companies are ginormous, like Facebook, Netflix, Apple, those are called large cap. If they're teeny tiny, like Innovative Wealth Building, teeny tiny, earning less than $10 million a year of revenue as a public company, then you're a small cap. If you're somewhere between 10 million and a gazillion, then you're kind of a mid-size or a mid-cap. Interestingly enough, small and medium-sized companies have more risk, so long-term, you'd think they'd have more returns. Well, in 2024, that did not play out. In fact, the largest, safest companies had the better return. And this isn't recent. For several years now, the large companies have actually outperformed the small and the medium companies. Again, just something to be aware of as you have your TSP, your 401k, your investments. Sometimes I'll see people that are really weighted towards small caps because theoretically they're going to perform the best. That's not always how it plays out. So just keep an eye on things. And if something's not working, maybe make an adjustment and then keep those things in mind for future purposes. So again, just to let you know, large companies outperform small and medium in 2024. That's happened for a few years now. Another thing you can think about is your investment style. Within investing, we have blend, which is just, kind of the average of everyone, and that's what the S&P is. And then we have growth and we have value. Value stocks are things like maybe your Costco's, your Walmart's, your AT&T's, your ExxonMobil's. Your growth stocks, those are your crazy ones sometimes. Your Apples, your Nikes, your Starbucks, maybe NVIDIA. If you're doing AI, we'll talk about that later. You probably can guess what stocks did better in 2024. When we compare the S&P, which was at 25%, growth stocks had a 33% return, value stocks had a 16% return in 2024. Again, you kind of get what you pay for. If you're a more safe investor, there's a chance that we, as your advisors, said, let's do some value investing. And it was safer and it had a lower return. If you're someone who's more aggressive, then we probably tilted towards growth. And then that's where you got a little bit more of that extra juice. So that's, again, how this all works. The general stock market does what it does, But depending on if you want to be a little more safe, a little bit more aggressive, small companies, large companies, medium, then we have some variations in how the stock market performs for us personally. So what's the point? Again, we don't control the stock market. I guess if enough of us do something at the same time, we can move the market a little bit. But in general, we want to be in the market more than we're trying to time in the market. So just make sure you have a balanced approach. Typically, being diversified is a great thing, but then just knowing what you're looking for and the risk you're willing to take can help you or your advisor work together to make tilts and tweaks to strike that right balance between risk and return for your particular portfolio. So now we're going to talk about the bond market. Again, if you have any questions, comments, feel free to just chime in. Whether they're good or bad, I'm cool with public humiliation. So if you want to make a joke about me, that's cool too. Just type it in the chat box and I will read it aloud. Don't worry. But now let's talk about the bond market. We said stocks were good in 2024. How do we feel about the bond market? So, yeah. Oh, Brian, did you have something to say or was that an accident?
That was an accident. I should be on mute, but I said it looked like it came back later in the year.
Hey, well, you're kind of right. We ended up positive in 2024. It was a little bit bumpy. Bonds have been a tough ticket. So, does anyone else have a thought on how the bond market was in 2024? I can assure you, not as exciting as the stock market, but I'm about to show you some numbers, and it may or may not be a little bit surprising. Okay, I don't think I see any takers in the chat box. Let's move along. Bond market. We said earlier that we evaluate the S&P by looking at the we evaluate the stock market by looking at the S&P 500, which is a basket of stocks. Well, we evaluate the bond market by looking at something called AG. No, that's not AG for someone named Agnes or the agitated person at the library. AGG is an investment portfolio that I call the pepperoni pizza of bonds. It basically takes the average bond in the US and looks at it to see how it does. The average bond is called an intermediate bond. It's not short-term and super safe. It's not long-term and more susceptible to interest rate changes. It's just kind of in the middle. It's a pepperoni intermediate bond. And AGG is the BlackRock, or excuse me, the iShares Intermediate Bond Index. And that's how we know how bonds are doing. So how did AGG do last year? Well, here's a look at the last 8 or 9 years. The returns have been, up and down, but in 2024, it had a 1.31% return. That's not so great. Now, compared to 2022, when bonds lost 13%, maybe 1.3% is okay. But all other things aside, that's maybe not the reason we buy bonds. We want safety, but if our bonds are earning less than our bank accounts or our CDs, then maybe we're not so happy with what the bonds are doing. So if you're looking at this chart, bonds tend to react opposite of how interest rates react. With COVID, interest rates were at 0. So then once interest rates shot up, bonds fell off the cliff. And that's why we saw and we see this big drop on the chart. And then it's kind of climbed its way back up as interest rates have been reducing or lowering a little bit the last couple years. Just like stocks, there are lots of types of bonds. There's short-term, intermediate, long-term, governmental bonds, corporate bonds, international, US, municipals. There was one bond out of these that had an 8% return last year. You can probably guess. It's the box that's green on the screen. I didn't make that rhyme on purpose, I promise. That kind of rhyme too. But the high yield bonds had about an 8% return in 2024. So this is a real quiz question. Does anybody know the nickname for high yield bonds? There's a nickname that I think is really interesting. So you may have heard it from Jim Cramer or someone else. I'm just curious if anybody knows what the nickname is for high yield bond. Because if you're me, you're like, hey, it earned 8% last year. Why didn't I have more of those? So does anybody know the nickname? It's a four-letter word. So it's a blank bond. Not that four-letter word, probably not that four-letter word. The four-letter word is junk. So high yield bonds are also called junk bonds. Why? Because they're risky. They're the riskiest type of bond that you can get, and that's why they pay the best interest. That said, they tend to have pretty high volatility. So if you were a junky bond investor, maybe it was a good year last year. Most people are probably not using a high allocation of junk bonds. Maybe you have some, but again, all things ebb and flow. 2024, maybe that was the year of junk bonds. 2025, maybe that won't be the case. So the point here is, just to take a look at your portfolio and understand what type you have. And you may need to make some decisions. So, real life scenario, we have clients that have municipal bonds known as munis or tax-free bonds. They earn returns, but the returns are federally tax-free. So let's say you have a tax-free bond earning 1.5%. Or you could get a taxable CD that earns 4.5%. Which is the better deal? The tax-free 1.5% or the taxable 4.5%? Well, I majored in economics, not mathematics, but what I can tell you is I'd rather earn 4.5% and pay the taxes because that's still double the return of the 1.5% tax-free. So again, within your portfolio, if you're managing it or if you're working with an advisor on it, all these little things matter. Your advisor's likely making some adjustments on your behalf with these things in mind. But again, with your 401ks and your other assets, these changes are likely not being made. And if you're not looking at it or you don't have someone looking at it for you often, this could be an opportunity to make some adjustments to make sure your portfolio is working the hardest that it can for you. So again, lots of bonds out there, lots of ways they work. You want to just make sure you have the ones that are working the best for you this year, the next year, and so on and so on. So as far as the stock market, we talked about US versus international, small versus medium versus large. We talked about lots of bonds. I'll kind of land the plane here on the stock market with two big things for you to think about: your risk tolerance and your risk capacity. Risk tolerance is just how you feel. How much risk can you take on and feel okay about it? Whereas risk capacity is how much risk can you afford to have? Those are two different things. How I feel about risk tolerance could be, you know, how much pizza can I eat without exploding? Versus like my risk capacity could be, how much pizza can I eat to not be on track to gain 10 pounds a year if I continue to eat that much amount of pizza? I only threw that out there because Kenna's probably watching and she's counting my macros this week. We're doing a little challenge. So in other words, risk tolerance is how you feel about risk. Risk capacity is more so how much risk is responsible relative to your goals. Again, that's one of those things we think about, especially as we get closer to retirement, and we just want to make sure that we're not taking too much risk. I was going to do a quiz question about what topic was coming next, but it's already on the screen: interest rates. In general, I think most people are not super happy with interest rates in 2024. We're still seeing that buying a car, buying a home, buying literally anything is somewhat expensive because although in general interest rates have been coming down, we haven't necessarily seen that when we're buying a car, buying a house, with student loans, or really anything else. The important takeaway with interest rates is you just want to be aware of opportunities to either save money or maybe make money. So there's a thing called a HELOC, also known as a home equity line of credit, and these can be great. You can take money from your house and use it for whatever you want. Now, at one point, HELOCs had low rates, let's say 6 or 7%. Well, as interest rates have gone up, those have gone up to 8, 9, 10, 11, 12%. I sometimes see people making payments towards their HELOC. Let's say their payment's $1,000 a month. They might be making $1,000 a month payment and $999 is going to interest, and $1 is going to principal. They're never going to pay that HELOC off. So if you have a HELOC, again, a home equity line of credit, might be worth taking a look to see what the interest rate is. With your own mortgage provider, you might be able to talk about, you may be able to go to your mortgage provider and have them lock in your rate for a longer time period, but actually lower it. So again, just be aware that variable rates such as HELOCs can change over time, and that can make a big difference on how much of your payment is going to principal and interest versus, or excuse me, to principal versus just interest. When it comes to loans, I'm not saying you should go take a 401k or a TSP loan, but if you have a need for money, those can sometimes be more inexpensive ways to access capital. Recently, I saw someone who was able to take a retirement plan loan at 4 or 5% versus if they would have taken that loan somewhere else, maybe getting one at 8, 9, or 10%. So we don't want to take away from the assets we're building from retirement, but we do want to be aware that there's lots of pots we can pull from if needed to get through certain situations. There's a tool called a pledged asset line through Schwab. Let's say you have $100,000 in your brokerage account. You might be able to take a loan from yourself. Cut out the bank, take a loan from yourself using your investments as collateral. You can then use that money for something, and then you can pay that loan off whenever you want to. So that's just another way that you can take advantage of opportunities. Think something like flipping a house or renovating a home or something like that. There's lots of implications for how you could use your own assets. But again, just another idea of how you could get access to capital without necessarily taking a loan and paying certain fees to get a loan from somewhere else. I'll do a couple quick things, and then there's something in the chat box that I'll take a look at. There's a game that I like to play called Credit Card Roulette. I would only play this game if you feel confident. There are certain credit cards that will allow you to borrow money, and they'll charge you zero interest for 12 or 15 months. If you're able to put some expenses on a credit card and then put that money elsewhere to grow for a year, you could perhaps take that money, pay off the credit card. There was zero interest, and then all the gains you made that year, you get to pocket, and it didn't really cost you anything but the time. You can do this with CDs, or if you want to be more aggressive, you could go put it all in Bitcoin and see what happens 12 months later. Again, not a recommendation that you should do that, but sometimes using a credit card at 0%, even if you pay a 3% fee to transfer a balance, can be better than having a credit card at 15 or 20% interest rate. So just something to think about. The last thing I'll mention, I called it asset shifting. Basically, there's banks out there that if you take your money and open an account with them, they'll give you 500 bucks, $1,000, $2,000 up front. And all you really have to do is open an account, maybe have direct deposit, and let the money sit there for a certain amount of time. For some people, maybe that's worth it. You know, moving the money, sitting it there, earning $1,000, and then you move it back to your other bank and you use that $1,000 to do something fun for yourself or your family. So just being aware that there are different banks out there with special offers that you might be able to easily take advantage of. What about home equity loans? I would say home equity loans are similar in the way of home equity lines of credit. Whenever you're using that house as an asset, yeah, you can absolutely take a loan. With a home equity loan, it's likely or it could be a fixed rate versus variable. So yeah, there's all sorts of ways to solve short-term or long-term needs using your assets or even taking loans based off assets you own. So yeah, home equity loan could potentially be a good strategy. So hopefully interest rates continue to go down. And if you have variable payments, you can lock them in to a fixed rate that's lower. But we're still in the middle of this period where rates are not as low as we would hope. And, you know, fingers crossed that changes in 2025. So there was a comment. I'm not that good at talking and reading, so let me read it for just a second. Okay. Yeah, so there was a comment about just bonds versus dividend funds. And I said earlier that bonds are typically a safe part of our portfolios. And in general, bonds didn't have a very good return, maybe 1.5% last year. There are portfolios that pay dividends where the dividend portfolios are safer than the stock market. They're more aggressive than, say, the bond market or a bond fund, but then you get a nice dividend and you're kind of somewhere in the middle. So yeah, they're all definitely trade-offs. What I would say about a fund that gives you a high dividend, comparing it to a bond, I'm sure it's much more aggressive. Comparing it to the stock market, it's much less aggressive. But that can be a good strategy as well. So I don't think most people should be all stock or all bond. I think for the best outcomes, we're typically somewhere in the middle. Those high dividend stocks usually fall into that value stock bucket that we talked about, that in general were a little bit lower returns than the growth stocks, but it's lower risk and you might even get a nice dividend. So yeah, thank you for sharing that and asking about that. Definitely a good part of overall stock market and investments. Oof. Let's talk a little bit about inflation. I'll be honest with you, as I think about just groceries, I don't even want to talk about this topic because other people are probably seeing when you go grocery shopping, the prices are pretty intense. So as far as inflation, I'll just make a comment here. We're still seeing inflation, and the numbers aren't that bad. You know, the target inflation over the long term is around 3%. Inflation's not that far off. Once upon a time, we were seeing 7% inflation, and that's when we were seeing I bonds, inflation bonds that were paying a high return. But when you're measuring inflation now, in general, it's not that bad. Now, part of the problem with how we as a country measure inflation, it's a basket of goods that we allow certain types of accounting that maybe doesn't represent what's really happening in the real world. So I'll just suffice to say with inflation, it's happening. Hopefully, as you're seeing prices going up, you're also having pay at work that's going up to keep up with it. But just know that even though it says 3% inflation, when you look at healthcare, you look at other specific things, they're maybe going up by significantly more than just 3% inflation. Overall, I would consider inflation to be a bit of that lemon scenario. There's an old saying, when life gives you lemon, you make, something. Usually in person, someone will yell lemonade. I looked for lemonade online, but what I came across was something called a London lemonade. And based off it being like a clipping from liquor.com, I don't think this is grandma's lemonade that she was talking about. But with the inflation lemons, there is lemonade that we can make. And some of the ways that we do that is to stay invested. I said it earlier, the stock market had a 25% return in 2024. So if inflation was 3%, the stock market was 25%, you made 22% on those dollars net inflation by being invested. Another way to keep up with inflation is to own assets or to buy assets. Um, Things like houses, any type of asset that doesn't depreciate like a car can be a good asset when you see inflation. If you look at something like gold, gold went up over time because it's a hedge for inflation. Again, cryptocurrency, which we'll talk about, maybe that's a hedge for inflation. So just buying and keeping assets over time can be a good hedge for inflation. Looking for opportunities, when just with the economy having different changes, there are opportunities around us. There are buildings that become vacant that maybe we can revitalize and use for some type of business purpose. There's maybe a rundown home that we can renovate and make beautiful for someone else to move in and use it as a rental property. There's just all sorts of ways we can find opportunities. A beat down stock that has opportunity to turn around and do better. So just keep your eye out for opportunities to invest in some type of asset to not only keep up with inflation, but outpace it. When the going gets tough with inflation, I would say to go back to your budget and take a look. To start 2025, Kenna and I, my wife Kenna and I, we decided to look at our budget. I'll tell you the truth, it wasn't pretty. one of the things we did was we downloaded the Rocket Money app. And with this app, it basically will tell you all of your subscriptions and it will suggest things that you could do to save some money. So what does Terry do? I look at the app and I'm like, huh, we're paying for two Adobe subscriptions, and I honestly didn't realize it. So I got rid of one of them. And then it showed me some other subscriptions that, maybe I don't need. So I was able to get rid of them. And then you can sort by your biggest expenses. We used a different tool to look at how much money we spent on food in 2024. And after we fainted and came back to, we made a plan for 2025 to reel it in and do better in that category. So inflation stinks. Maybe it's a good opportunity to see where you can save money and even just make commitments to try to stick within a certain amount of spending so that you can save and invest or just reallocate that money to other parts of your budget. Lastly, I would say keep an open mind. The truths about money in 2025 are going to be different than 2015, 2020, or even 2024. So I would say that the best investment is in continued learning. And you just learn by being open to what's available and what's new. And of course, you don't want to listen to everything and try everything new, but to just keep an open mind to new opportunities. Maybe that was said on purpose as we talk about cryptocurrency. So legally, cryptocurrency in its most broad form is not an investment yet. There are certain forms that are investments. So I'm not going to be giving advice to go purchase any types of cryptocurrency, but just talking about them a little bit conceptually in the context of 2024 and then 2025. So this chart shows you what happened with Bitcoin's price in 2024. As you can see, it started the year, it kind of went up, and it kind of went down, and then it did this crazy, we call it like a hockey stick thing, and then it kind of has continued to go up. Does anybody know like the 1 year return in 2024 for Bitcoin? And for the purposes of this, BlackRock and a bunch of others launched a Bitcoin fund that investors can buy through Schwab or through most places. And that and Bitcoin, the actual coin, had the same return in 2024. Is anybody willing to guess the return on Bitcoin in 2024? We said earlier the stock market was around 25%. So let's see if we have any brave guessers on how Bitcoin did in 2024. Okay, John says 50%. Any other guesses? I'm going to just give you a hint. It's higher than 50%. Sorry, Cynthia, I didn't say that early enough. So who wants to go higher than 50? What's a number higher than 50? Whoa, Troy, 150. That's too high. So thank you for playing. Bitcoin had 133% return in 2024. Admittedly, a lot of that took place following the election results. Now, I've invested in cryptocurrency for years. It's probably been 6 years now. And I know this firsthand because I looked at my account one day and then a week later I was like, dang. So this hockey stick thing, it really happened. So yeah, Bitcoin had a 133% return in 1 year in 2024. That said, there's been years where it's been really terrible. Now, you can invest in Bitcoin or you can invest in other things related to Bitcoin. There's one stock that I think is interesting. Again, this is not a recommendation to buy it, but there's a guy who owns a ton of Bitcoin and he has a fund or a stock you can buy into. And their whole strategy is basically to just buy Bitcoin and buy it in a way where they can earn even bigger gains than Bitcoin itself. The stock's called MicroStrategy. In 2024, their return was 554%, which is just stupid. So if anybody out there has a time machine, give me a call. Let's both go back in time, take all of our money, put it in MicroStrategy, and we'll have 5 times the money by the time this webinar happens a year later. So I hope this doesn't give you FOMO or make you think, what on earth? But as I was getting ready for this presentation, and MicroStrategy is a fund or stock that we're aware of anyways, I didn't even realize it had 5x'd in the year, which is astronomical. Again, in fairness, if Bitcoin crashes, I can assure you MicroStrategy is going to tank as well. But this just shows you the magnitude of returns when you invest in crypto or things linked to crypto that are using leverage. So can be scary good going up, but also scary good or scary bad going down. So this is Mr. Michael Saylor. Again, he's a billionaire, super wealthy. He is the one that runs the MicroStrategy stock. Um, so for just a moment, I wanted to talk about some of the things that I've seen. Recently, there's been talk about trying to add Bitcoin as a national reserve asset for the United States. Instead of dollars, which we know don't grow by that much, if we had crypto in the National Reserve, and this isn't me talking, this is other people around the White House saying this, well, if we just hold Bitcoin instead of dollars, we'll eliminate the national debt because it's going to grow. As long as it grows, they're 100% correct. If it drops 50%, well, there's another $50 trillion of debt we have. So regardless, they're talking about it. So I just want you to be aware that Bitcoin being a national reserve asset for the US, that's on the table. The cryptocurrency task force, no, they're not searching for people with cryptocurrency and taking them to jail. Instead, they're lobbying with the Securities Exchange Commission, which regulates us, to say, hey guys, maybe you should be more nice to cryptocurrency. Maybe you should cut them some slack and make the rules a little better so that more people own crypto. And a third thing is just nonprofits accept crypto. So this can be a real life thing. Let's say you have a charity that you care about and you want to donate. And let's say you also happen to own crypto and it's gone up times 10. Don't give away cash. Give away your highly appreciated crypto. The nonprofit can accept it. They'll pay no taxes on it, and you'll get a monster deduction on your tax return. So again, that probably applies to maybe 1% of people out there. But if you're charitable inclined and you have crypto, it's a great asset to donate. Again, Ken and I have some. I'm in the process of giving some away. Yes, because I like to give money. Second, I don't mind the tax rate break. So a good item to use for tax breaks. A few questions, what to buy. If you're going to go buy crypto, I would say you should stick to the basics. The basics are Bitcoin, maybe Ethereum. That's it. Bitcoin really is the most basic. So if you're going to buy something, I would start with the basics. If you go buy Doggy Coin and all the other things out there, you could potentially lose a lot of money really, really fast. Or you can make a ton of money overnight. It happens. So there's a gazillion tokens out there you can buy. My advice is if you're going to dip your toe in the water, start with the basics. When you buy your first car, you don't go buy a Maserati. You buy a Honda Civic, or you buy a Nissan Sentra, or you buy a car for 50 bucks. You start with the butter knife. That's what my mom did. So you don't go buy the crazy thing first unless you're using a tiny bit of money and you don't mind losing it. Next is where to buy. If you want to do something super basic, really safe, you can buy Bitcoin through Charles Schwab. I was going to say Vanguard. I don't know if they allow it, but Fidelity, Interactive Brokers. I said the fund earlier. It's IBIT. That's the BlackRock Bitcoin Fund. If you don't like BlackRock, just type in your Google search, Bitcoin or cryptocurrency ETF mutual fund, and you'll find one, I promise you. So you can just buy it straight through the stock exchange. Or if you want to be fancy and do what the young kids are doing, you can go to Coinbase, Crypto.com, Binance, one of those places, and then you can learn about what a wallet is and all that good stuff and buy all the crypto you want. How much to buy? Don't buy more than you can afford to lose. Generally, professionals are starting to say 1 to 5% of an allocation to cryptocurrency may not be crazy. And then the best buy, not like the place you get laptops and computers, but the best place to buy crypto. Let's say your kids or grandkids have a Roth IRA and you just want to shoot your shot, theoretically drop a big chunk and spin the roulette wheel. I don't know if that's a real thing. I don't gamble. you could just buy some Bitcoin or crypto for them in their Roth IRA and just say, hey, let that go for 20 years or 5 years or 10 years. And it could go really, really high. So right now, the professionals are saying that Bitcoin could reach $1 million a coin by 2030. It used to be pennies. Now it's $100,000 a coin. If it goes to $1 million a coin, and let's just say you gave 5,000 and it goes to 50,000 or 100,000 in the next 10 or 15 years, that's pretty dang cool. Now, if the 5,000 goes to zero, well, cool. It's 5,000 bucks. But that's the thing about investing. There's no cap. It can go up forever, possibly, or it can only go down to zero. So your downside is known, your upside is unknown. So for some people that are willing to take the risk, maybe not a bad risk. Again, if you're going to do it, I do it in a Roth account. The crypto we own is not in Roth, so it's not tax-free, and I'm not happy about that. So that's why I say the best buy, if you're going to do it, might be a Roth, especially if it's going to sit there for a while for someone you care about or yourself. Care about yourself, do it too. Up to you. Again, not a recommendation. We're going to quickly talk about artificial intelligence. This picture is a little funky. Do I have any dog people on the line? Any dog people, cat people? Well, you're in luck. Someday there's going to be a digital dog or cat, basically a walking, quacking, barking chat GPT. Yes, I said quacking. Some cats quack. And it's going to be freaky. So this thing is just getting started. If we're thinking baseball and there's 9 innings, artificial intelligence is like in inning number 1, maybe getting close to inning number 2. It's a little scary to think about what it's going to look like in 2, 5, 10 years. Years ago, I saw iRobot, and that doesn't seem to slow any people down out there that are building these humanoid robots. Like, we're really possibly going to be at that point at some one of these days. So again, you're probably seeing that in 2024 and 2025, there's been wider adoption of artificial intelligence. You've seen new competitors. It's not just ChatGPT. There's Claude, there's Gemini, there's all these other custom LLMs. I think that's just something language models. And there's more coming. We saw DeepSeek came from nowhere, although they were already talked about before that happened. And I'm going to talk about that more in a second. AI has more features. If you're willing to pay for it, you can have your AI review all the news articles on X topic and give you a 2-minute breakdown every Monday morning at 8 o'clock that you can read with your coffee. You can talk to your AI and it can talk back to you. So it's just getting crazy out there as far as the implications. And then the practical use cases are just going to become bigger and bigger. All that to say, if you're not currently using AI, I would probably suggest starting to test it out. The professionals out there say AI should create a lot more jobs. And it's not necessarily that AI is going to take everyone's job. However, if you want to be competitive in the working force, being a person who knows how to use the tools is going to go a long way. So that's what I hear. Terry, your job's not going away. Just the advisors that don't use AI are going away. Whatever, I don't know. But there are some great use cases, and it's just like anything else. I would say to start to learn about it, start to practice it. It has some really good implications. My jokes are really bad, but if I want some jokes to tell in a scenario like this, ChatGPT can help give me the corniest jokes you've ever heard. I don't know if that's good or bad, but in 2 seconds, I can get 20 jokes that I can use, which I'm going to do in about 5 minutes. So hopefully your seatbelt's buckled. All right. Monday. So NVIDIA or NVIDIA, this is one of those artificial intelligence stocks. I own a lot of stocks. I own this stock. And if you have any money in the S&P, yeah, you own a little bit of NVIDIA too. Well, on Monday, I saw a couple messages on my phone. And when I looked at the stock app, which I look at way more often than any human should, I saw NVIDIA was down 17% in one day. 17% in one day. That's pretty bad. That might be the biggest, I think it was the biggest loss of value for any stock in history because they're so big and they lost so much in one day. So, all that to say, investing in the cool, hot thing sounds really, really fun. But you just got to remember that the upside and the downside is real. And you should only use the money that you are comfortable seeing go the wrong direction as well as the right direction. So just Monday, it went down 17%. The next day, it was up 8%. Today, I think it went down another 4%. So it's doing a little bit of the up and down thing. And that's all because it had a new rival come out, a new company that could maybe challenge the dominance of NVIDIA or maybe cause people to question, is it really as great of a thing as we thought it was? And then just like that, it all changes. So just something to be aware of. There's going to be more challengers out there, more competition. Just invest wisely and keep in the back of your mind, by the time you see it on TV or I'm talking to you about it, maybe you missed the opportunity, depending on what it is. And if you come too late to an opportunity, those are often the people that lose. So there's been plenty of real cases where that's happened. So just a warning about investing just because we saw other people doing it. If you have a good reason, that's great, but just be aware the downside is real. If you do want to invest in different types of artificial intelligence, you can buy stocks, you can invest in funds, be that the S&P or a mutual fund that's specifically technology or even artificial intelligence focused. You can do certain private offerings. If you're an accredited investor, which basically means maybe a net worth over 500,000 or $1 million, you'll get little things in the mail where people will invite you to private investments, like SpaceX, like ChatGPT. You can invest in those even though they're private right now, but it's not available to everyone. Um, how to invest. My last bullet says training. I don't really know what that means. What does that mean? I'm not even, honestly, I'm not really sure what I said. Maybe that meant by training yourself on how to use artificial intelligence, that's a way to invest in yourself. I'll be honest. I wrote those bullet points yesterday flying back from Kansas City. So I don't know. I'll have to check with someone to see what I meant there. As we get ready to conclude, I like to bring it back to the two circles, right? There's one circle of all the things that matter in your financial life, and then there's a circle of all the things that you can control. Naturally, what we say to focus on are the things that matter that you can control. You know, looking into your finances and being interested, you can control that. Educating yourself or working with a partner who helps educate you, you can control that. Saving more, reviewing your budget, things of that nature, that's within your control. The things that aren't in your control, you got to let those things go because they'll just weigh you down. So, in summary, we talked about portfolio and some of the things to think about. We talked about how stocks are doing, we talked about how bonds are doing, and how overall things have been pretty good the last year or so. So, just keep an eye on your goals and ensure your portfolio is in alignment with the goals you want to achieve. We talked about interest rates. They're still somewhat going down. We had several rate cuts in 2024. 2025, we'll see what happens. I don't think we're going to have the big cuts that maybe we expected. Again, this isn't Terry talking. Those are the smart economists saying that. But we'll see what happens. Fingers crossed, cars, homes, loans go down in interest rate and things become more affordable. Inflation doesn't seem to be a huge issue right now, but we're still feeling it. Every day at the grocery store, at the gas station, we're still feeling it. And we can't control the prices, but we can look at our budgets, see where we can trim. And we can also just be mindful that small day-to-day choices make a big impact long term. So try to balance having enough to be comfortable and make ends meet today, but also planting seeds that are going to grow and provide for your future. And then the last thing is just with innovation. It almost feels like, 2000s or other times where the internet was here and everything was being touched by the internet. And now it's like AI is here and everything's being touched by AI or blockchain technology. We don't want to get caught up in it, but we do want to be a participant and a learner so that we don't get left behind. All these fads aren't going to stay. There's plenty of things that will go away. But if we can just be involved enough to learn and take advantage where it works for us and our family and our businesses, then I think we're going to be putting ourselves in a pretty good position long term. So we started 5 minutes late, which for some people's on time, but for others, that's 5 minutes late. So sorry about us being a few minutes behind, but we are done almost 5 minutes early. So that's all the content I have for you today. I will keep an eye on the chat box to see if there's any specific questions you have. While I'm waiting for anyone to write a question, as always, just wanted to say thanks for joining us today. We hope that you found some value in today's conversation, and these topics are about you. We put out some surveys. We heard from you all about what you wanted to hear about. We're going to continue to keep our ears open. So if there's topics that you want to hear more about or other things we can do, just let us know and we'll do the best we can to provide some value. So if there are no other questions, I will just say thanks so much for spending some of your time today with us. We hope you took away a couple things you can turn around and apply and utilize in your day-to-day life. And it is our privilege to have the opportunity to know you and to serve you and your families. So enjoy the rest of your day. Stay safe, stay warm, depending on where you are. Brian, I'll answer your question and then any other questions that come in. But for anybody else, thank you so much. Have a great one, and we'll see you next time. So any thoughts on the impact of tariff actions on US and international stocks? Huh, that's a good one.
I
In
realize that's crystal ball question, but yeah, I'd be very interested since I know you're watching.
Yeah, that is going to be a really interesting one. Depending on who the tariffs are on, by having tariffs on certain people, we could make things more expensive for ourselves, and maybe that's not a good thing. When you think about businesses that want to make money, you have your revenue and you have your expenses. If your expenses go up because people around the world are no longer playing nice and your materials cost more, your profits go down, and then that hurts the stock market, that hurts other things. So yeah, unfortunately, I think it's going to be a complete toss-up with how things are going to play out. At the end of the day, I think it's as a country, us having the right alliances, I guess, that work for us and not making the wrong people mad that are going to hurt us. But with it being such a collaborative global economy nowadays, things are so interconnected. I think it's going to be a really interesting 2025. And the sectors that I'm watching, definitely really interested to see what happens with electronic vehicles and autonomous vehicles. That's going to be interesting. Federal government is having some huge challenges and shakeups and changes. So that's going to touch a lot of different things. Just the basic things like oil and gas and just materials. As a country, we still have a housing shortage. So seeing how that plays out, at what inflection point enough retirees or people that pass away are going to sell homes, or their beneficiaries are going to sell homes to where we no longer have a housing shortage in America. So for me, the biggest sectors, I'm really interested in what happens with technology, because now you've got Meta and all these people racing to try to figure out, does DeepSeek really know something we all don't? And all these people are trying to remake batteries to power cars and solar in our roads. So infrastructure, technology, I think it's going to be a really interesting 2025. Brian, do you have any in particular and one other one is just data storage, data centers. We're using all this data. Where does it go? How do we protect it? That's going to be interesting.
That's the one I was interested in hearing whether it was on your radar because, and by extension from the data centers, something that's piqued my interest is new nuclear reactor technologies. There's a couple companies out there that are starting to gain some acclaim and some attention for their smaller, reduced footprint designs, which could bring nuclear back to the fore as the source for a lot of these data centers. So I'm just now starting to really watch this stuff, and I just wondered if it was on your radar as well.
Oh yeah, It's going to be crazy. There's so many things going on, and they all touch each other and connect in different ways. So while everyone's looking at the electric vehicle or they're looking at AI, they're not necessarily thinking about what powers it. Like you're saying, the power, and then like where it's stored and how it's protected. It's going to be really interesting. I saw something that said ChatGPT, the amount of energy it uses is like tens of thousands of flights, and the cost of like the gas of the pollution of an airplane. And it's just like, yeah, we're working so hard to have these advances, but there are costs to it, and the costs aren't always obvious up front. So yeah, I think it's going to be really, really interesting. And I think you're on to something. Yeah, it's all about power, it's all about storage, it's all about data. Um, it's going to be an interesting 2024. I'll look forward to a year from now doing the recap of what we saw in 2025. I think that's going to be pretty fun.
Yeah, thanks for that. And the other thing I'm watching, and I'll probably be talking to you and Warren and Jennifer, I think stocks like Dominion Power, and
Hmm.
also I forget what company owns the Calvert Cliffs reactor. I think that they're going to be the backbone up and down the East Coast of supplying that power, regardless of how it's where it comes from. So, anyway, thank you very much. This has been a fantastic way to kind of end the workday.
Oh, of course. Thanks for attending. And yeah, we'll look forward to talking next time.